Welcome to the Deep Dive. Today, we are talk tickers, and we're digging into, well, probably the most explosive earnings report we've seen this quarter. Sandisk's Q1 fiscal year 2026 results. And look, what we have here is way more than just a strong quarter. It really feels like a definitive signal that the structural flash memory upcycle isn't just, starting. It's accelerating hard with serious momentum. You're tracking the tech cycle. You really need to get what this call revealed.
That's exactly it. That's the core takeaway. The whole narrative, it's completely shifted. We are past the recovery phase now. This call signals aggressive execution, and it's driven by, well, two main things: a tech leverage, specifically their new BiCS8 node, and really favorable pricing dynamics that management thinks will stick around much longer than maybe analysts first thought.
Okay, let's break down the numbers first, because, they really set the stage for everything else, right? Revenue clocked in at $2.308 billion. Their guidance, the high end, was $2.2 billion, so they smashed that. That's a 23% jump year over year and 21% just quarter over quarter. That's real breakout growth.
And the profitability just followed right along, dramatically so. Non-GAAP EPS, $1.22. The street was looking for maybe veal or 88 cents. So yeah, a huge beat there. But what really tells the story about the cycle, I think, is that gross margin expansion.
Yeah.
Non-GAAP gross margin popped, 350 basis points sequentially? That's 3.5 percentage points. Bang.
Yeah.
Up to 29.9%.
And if you pull out those temporary costs they keep talking about, like the startup stuff and underutilization, that gross margin jumps again, right?
Right, gross margin jumps again.
It's at 33.1%.
Yeah.
That speed, that velocity of margin improvement, it tells you everything you need to know about what's happening with pricing out there.
Definitely.
And on the cash side, they generated $448 million in adjusted free cash flow. That's a 19.4% FCF margin. Pretty healthy. This flood of cash let them hit a really critical balance sheet milestone.
The net cash position. Yeah. $91 million. They'd set this as a target during their investor day, and bam, they hit it about 6 months early. Having that clean balance sheet, well, it changes the whole game for how they handle capital allocation going forward.
Okay, let's switch gears to the supply-demand picture, because that's really the engine behind these financials, isn't it? Management confirmed what everyone suspected. Demand is just running ahead of supply.
Everywhere. Across all end markets.
Right.
Their stuff is on allocation. You literally cannot just call up and buy all the flash you want right now.
And that scarcity, it's changed how customers are behaving. This is where you get some incredible visibility. We heard on the call, customers are now proactively locking in long-term deals just to guarantee supply.
Okay, but long-term,
Like really long-term. Some of these talks are apparently already stretching out visibility through calendar year 2027. Think about that. This isn't just some cyclical bounce. It feels like years of demand locking in now. Wait, hold on. CY27, for a company that usually lives quarter to quarter, why would these huge customers like the hyperscalers commit to price and volume 2 years out? Is it just fear of a shortage, or is it more like confidence that they absolutely need this generation of flash for their build-outs?
Probably both, but most of the second one, I think. They seem terrified of not getting enough product to fuel these massive AI and cloud expansions. If you look at where the demand actually came from sequentially, it just paints a picture of this economy aggressively shifting to high-capacity storage.
Right, so let's break down that sequential growth, the three main segments: edge, data center, consumer. Edge was the big one, right? There's OEMs, mobile, PCs. Came in at $1.387 billion, up a massive 26% quarter over quarter.
Huge jump.
And that seems driven by two things: the PC refresh, Windows 11, the Windows 10 end-of-life deadline looming, and also, crucially, the fact that capacity per device keeps creeping up. Mid-single digits, they said. Every new laptop just needs a bit more storage.
And consumer wasn't bad either. $652 million, up 11% sequentially. Okay, some of that's just setting up for the holiday season, sure. But they did call out a specific product win. That co-branded Nintendo Switch 2 microSD express card sold over 900,000 units just in Q1.
Wow.
Yeah, so having those kinds of high-volume consumer deals, it provides a nice, stable sort of anchor, even while they're chasing those, data center whales.
Okay, let's pivot to the tech, the engine room, really, because this drives the future margin story. It all comes back to BiCS8.
BiCS8, yeah. For anyone not familiar, that's their latest 3D NAND flash generation. Their node, think of it like instead of just a bigger warehouse, they're building a skyscraper factory. Stacking cells way higher, it drastically cuts the cost per bit and boosts the density.
Gotcha.
And this node is absolutely critical. It was already 15% of the bits they shipped in Q1.
Oh.
And the plan, BiCS8 becomes the majority of their bit production by the time they exit fiscal 26. This transition, this is how they get that margin expansion without just spending billions on new wafer capacity. It's all productivity gains.
And that tech leverage feeds right into the hottest segment, data center.
Mm-hmm.
Revenue, they're up 26% sequentially too, right?
Mm-hmm.
$269 million. Almost all AI demand. And they pointed to specific ramps.
Mm-hmm.
Their big Stargate Enterprise SSDs, they're in qualification right now with two major hyperscalers. And they've got two more big targets lined up for calendar 26. A third hyperscaler and a major storage OEM. That qualification pipeline, that's basically the roadmap for future revenue growth there.
And they're also pushing into sort of next-gen memory with high-bandwidth flash, HBF, actively talking to potential customers, targeting AI inference both in the data center and out at the edge.
HBF is really important because inference needs not just capacity, but super fast, low latency access to these enormous models. Standard SSDs can be a bottleneck. HBF is designed to speed that data flow way up. What really struck me, though, was just the sheer scale of the AI demand they're now seeing. Management didn't just, nudge their forecast. They reset it fundamentally. They jacked up their estimate for data center exabyte demand growth in calendar 26 from the mid-20s% range all the way up to the mid-40s% range.
That mid-40s number, yeah, it's seismic because it implies this structural shift in the whole market. Management actually projected that CY26, calendar 26, will be the first year ever that data center is the biggest segment in NAND, bigger than mobile.
Whoa, okay, let's pause there. Data center bigger than mobile for a pure play flash company. So they're going from serving the, volatile super cyclical mobile phone market to primarily serving these massive, stable, long-term infrastructure deals with hyperscalers. What does that do to their margin stability long-term? Does that change how we even define cyclical for Sandisk?
It absolutely should. It should definitely temper the cyclicality. Hyperscaler contracts tend to be stickier, right? And their demand curves are, long and steep, not spiky like waiting for the next iPhone. This structural shift is also driving their product mix. They're leaning hard into QLC.
Right, quad level cell.
Quad level cell. Basically stuffing 4 bits of data in every cell. It cuts the cost dramatically. Perfect for those huge storage drives like the 128 terabyte Stargate SSDs. They see QLC going from 20% of their business today to a massive 40% by the end of fiscal 26. That's the volume play, all driven by the data center segment.
Which brings us perfectly to the Q2 guidance. Yeah. This was the mic drop moment of the call, wasn't it? If Q1 was great, the Q2 guide implies this genuine step function leap. It reflects that compounding power, the tech transition, plus these sustained pricing tailwinds.
Oh, yeah. They guided Q2 revenue between $2.55 billion and $2.65 billion. Solid increase. But the headline, the number that sent the stock flying post-call, was the non-GAAP gross margin forecast. Get this. They're expecting it to jump to an astonishing 41% to 43%.
41 to 43%. In one quarter.
Yeah.
I mean, we have to stress how fast that profitability is rocketing up.
Yeah.
And a big mechanical piece of that is the cost headwinds clearing, right? Those startup costs are dropping off a cliff.
Exactly. Down from $61 million in Q1 to just $30 million expected in Q2. And then basically near zero after that. So they're shedding that drag just as pricing is exploding upwards. It's perfect timing.
Yeah.
And with that kind of margin profile, the EPS guide is just massive. Between $3 and $3.40 for Q2 alone. That just shows you how fast that financial leverage is kicking in.
And just to be clear on that Q2 revenue guide,
Yeah.
the driver is mostly pricing, yeah. They said double-digit price increases.
Primarily pricing driven, yes. Double-digit price hikes with only mid-single-digit bit growth. So that pricing strength they saw late in Q1 isn't just continuing, it's accelerating significantly. Into Q2, we are deep in a pricing cycle here. So what's the takeaway for an investor tracking the long-term story here? I mean, this call basically confirmed the high conviction bull case, right? You've got this pure play flash company, clean balance sheet, tech leadership with BiCS8, and they look set to translate this supply constrained upcycle into truly exceptional and maybe even sustainable profitability.
And the market clearly agreed. Stock jumped, over 15% after the call? Because the street seems to finally be buying into this idea that the company's structural advantages, the spinoff, the balance sheet, the node lead, will let them turn this cycle into structurally higher margins than we've seen in past peaks.
Right. So near-term things to watch. Pretty simple, really. First, do they actually hit that 40% plus gross margin in the Q2 results? That's the big confirmation. Second, look for news on more hyperscaler certifications for Stargate. And third, any confirmation of actual customer pilots starting for that high bandwidth flash tech. Those are the data points that signal if this pricing power and demand volume can actually last.
All right. Now it's time for our, let's call it aggressive, maybe asymmetric trade idea segment. And remember the standard disclaimer, folks. We're just summarizing what we heard on an earnings call. We are absolutely not financial advisors. This is just for informational purposes. Do your own homework.
Okay, so building on the conviction that, one, this gross margin jump to 43% isn't just a spike, it's maybe a new plateau. And two, that this mid-40% data center growth is still being underestimated. Here's the idea. The trade. Think about a calendar spread targeting, let's say, a $300 share price by mid-calendar year 2026. The thinking is, you've got demand visibility stretching out to CY27 now. You've got the structural cost advantage from BiCS8 becoming the main node by the end of FY26. That combo arguably justifies a premium valuation compared to old cyclical peaks. Now, this trade really relies on seeing maybe 2 more quarters of strong sequential EPS growth, confirming that $3.40 Q2 guide is real and potentially repeatable.
So a clean beat, a dramatic margin inflection point hit, and just deep structural demand tied directly to AI and the hyperscalers. It really feels like the NAND market itself is changing. And Sandisk looks positioned to ride that wave maybe better than ever before.
Absolutely. And here's a final thought, maybe something provocative for you to chew on. Management said they're committed to only growing their actual supply footprint in line with, say, a mid to high teens market KGR. Okay. But they're simultaneously projecting unconstrained demand running in the mid-20s or even mid-40s for data center. So if supply grows at X and demand wants to grow at 2X, what does that imply for pricing and allocation dynamics going forward? It kind of suggests the scarcity and the high pricing could last a lot longer than people think.
Yeah, it feels like this tightening cycle might just be getting started. Okay, thank you for joining us for this deep dive into the Sandisk earnings call. As always, we encourage you to dig into this data critically and do your own research. We'll catch you on the next deep dive. Remember, this is not investment advice.